So what should fixed income investors do now that we got the jobs report? Let's turn to Craig Bishop. He is with RBC Wealth Management, where he is the lead U.S. fixed income strategist. Craig, good to see you.
Good afternoon, Rhonda.
So I know that your belief is the Federal Reserve might actually not make a move until 2017, as that jobs report really was not a blowout number.
That's absolutely correct. For some time, we've been under the opinion that, it's 2017 at the earliest for the next rate hike. And that opinion really is driven by not just 1 month's jobs data point. It's really driven by, what we see both in the U.S. and around the globe that keeps the Fed on hold. Slow global growth, accommodative central banks around the world, and the Fed continues to try to figure out what the real or ultimate neutral rate might be. So low inflation puts them in no reason to hurry at the moment, in our opinion.
This, of course, also means it's difficult for fixed income investors who are trying to get some yield. Does your view change right now about what to do with a fixed income portfolio looking out to 2017? Where's the best spot for investors to be right at the moment?
Sure. It depends what type of a portfolio you're putting together. If it's building a portfolio of corporate bonds, right now we think the best point on the curve is that 7 to 10 year area. If you're a muni bond investor, it's further out of the curve, more so 12 to 15 years. But you're right, the ongoing uncertainty that we've had for months now as to what the Fed will do, when they will act, continues to create a lot of volatility, and it makes it hard for investors to decide what to do. I think what we continue to talk to our clients about is just that regardless of when the Fed does raise rates, interest rates are in a lower for longer environment, and that's going to continue for some time. So it just really depends upon, or makes it ever more important for investors to really have a strategy in place, follow the strategy, don't deviate from it in trying to add additional yield by taking on credit risk, taking on duration risk. Stick to the plan. Know what you own, basically.
So, Craig, I guess one issue for fixed income investors that some people say has not been factored in is that when rates do start to move, they're not going to be used to the returns that they get from the bond market. It's been decades, really, since we've seen the bond market that we're in. So once things reverse, there is potential to lose money.
That's right. I mean, if you look across every asset class, and we have these discussions frequently within our group, values are stretched. I mean, in this rush for yield, not just from domestic investors, but also global investors looking to the U.S. markets for additional yield, it's really pushed performance on a monthly basis to levels that we haven't seen in some time, and investors aren't necessarily prepared for when rates do begin to rise. So again, I think that being the case, it gets back to the point that we mentioned earlier, where from an investor standpoint, in fixed income is not without risk. It is an investment. Investing entails risk. You have to be prepared for market volatility and changing interest rate environment. But it gets back to just kind of trying to prepare your portfolio for that, not trying to predict when rates will rise, but taking advantage of current opportunities, but keeping an eye on the future for when that event or when those events might occur.
Would you expect that U.S. Treasuries are still favored, not just by U.S. investors, but by those foreign investors who have come to the market because we don't have negative interest rates?
Absolutely, and I think that's we can talk about the Fed keeping rates low and what that's done for the Treasury market and Treasury yields, but I think a big component, as you suggest, has been strong demand from foreign investors. That's driven yields low, and I mean, if you look at just the spread between our 10-year Treasury and 10-year bonds, continues to be a significant spread that makes it valuable for those investors to move to other markets. And that's benefited, or that demand from foreign investors has benefited Treasuries, but it's benefited municipal bonds. It's benefited corporates, investment grade and high yield. So all asset classes really have seen this strong demand from foreign buyers, and that's impacted yields and squeezed relative value across many of these sectors too.
Craig Bishop, RBC Wealth Management, thanks so much for your time.
Rhonda, it's been my pleasure. Thank you.
I'm Rhonda Schaffler for The Street.